Hello, Facebook Live. Thank you for being here. And I just want for our Wealthcast, and I want to talk about what happened yesterday. The Federal Reserve did increase rate of 75 basis points. So the Federal Open Market Committee wanted to tamp down inflation. And so why do we do this? What is the central bank officials and how does this impact us specifically? So the Federal Reserve's number one objective is to rein inflation. And ideally, they want to keep inflation at around, give or take, 2%. They're not really saying that right now because in May, the inflation rate came out at 8.6%. So they had serious concern. And as a result, they met yesterday. And at first, it sounded like they were going to do a modest rate increase, but they came out with this very aggressive rate increase of 75 basis points. So, what does that really mean, and why do they do that? So, the Fed funds rate is the rate that interbank loans charge each other. And that ultimately slows down or enters into society beyond interbank loans. So the biggest place that it hits first is consumer debt. So think of adjustable rate mortgages, think of credit card loans, think of auto loans. Ultimately, we will pay more for that debt. It eventually flows through to savings accounts and CD interest rates, but that usually takes a little longer for us to see the benefit of a higher interest rate. And so let's talk a little bit about inflation. Where has that come from? Is it transitory or is it systemic? And then what does that mean for us as it relates to our portfolios? So when you think about why all of a sudden did inflation just pop up? Um, it was high in March and then it was extremely high in May. And it's a number of different things that have effect on this. And so the first is um, it's pandemic related as it relates to supply chain demands, consumer pent up demands, the delay tied to the supply chain, and then Russia invading Ukraine as it relates to the price we pay for oil and what we're paying at the pump for our gasoline. So all of those things have a direct impact on inflation. And so, how much of that truly is a result of the pandemic that we just have to work our way through? And how much is that really systemic, that it's going to be around a lot longer in terms of employment and what we pay for salaries as employers or long term effects on the housing market? So it will be very interesting to see how much is short term, how much is long term, and what does 2023 look like as a result of these Fed funds and the Federal Reserve really being aggressive about raising rates. So they hope that they will start to see inflation trend down. They meet again in July. So what has happened is they decided to be aggressive at the expense of the capital markets. If they come again in July with another 50 to 75 basis point rate hike, um, the likelihood that we go into a recession is relatively high. So, as investors, what does that mean? Well, we hope that you're a long term investor and it's tied to a financial plan so that as we go through the ebbs and flows of recession and market cycles, that you're prepared and understand how that impacts your plan. Obviously, stocks are a hedge against inflation. Also, alternative investments like real estate investment trusts, or other types of things. So, recognize market cycles, recognize that the Fed and their ability to increase interest rates is to really tamp down demand so that supply can catch up. That's really the whole objective of increasing these rates so that it slows down the economy, so that inflation works its way back down. So, as we enter into July, as we go into the summer, don't get too excited, but do understand that if you do have debt, I would encourage you to focus on your debt reduction, particularly your credit cards, so that the higher interest rates by year end do not negatively impact you. So, if you have any questions, follow up. I'd happy to answer more afterwards when I have more time. But thank you and have a super, super day. Thank you. Take care.